and we'll get this event started. I'm going to proceed a little bit on the assumption that sound's working okay. The first thing I want to say is a hearty thank you. I think that's not the right word. Okay, let's call it a heartfelt thank you to FX Street. Thank you very much to FX Street for organizing this event and for inviting me back. I must have said something either right or something moderately intelligent or something to please a few people to get invited back to these events. For those who don't know, I was doing maybe 2 of these events per day. Or, sorry, not per day, but per week. I think it was just 2 events per week back in the last few months of last year. I changed into my coaching schedule at FX Bootcamp early in the year, prohibited me from doing too much in the way of public webinars, but another change in my schedule recently, and I wanted to get back into doing these on a more habitual basis. Yeah, glad to be back, too. Glad to be back. So let's get started. The purpose of this event, I'll start with a bit of a disclaimer, and I'll discuss briefly the summary for this event. And this will be, correct me if I'm wrong on anyone at Epic Street, but this will be a regular weekly event. I believe I'm going to be delivering webinars at this time slot, 1 p.m. New York time on Thursdays moving forward. Hey, Kevin. So get used to it. So first of all, let me dispense with a disclaimer. The purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but we'll take a look back at some historical price action, some recent news, particularly today's news. Boy, oh boy, how about the move on the euro today? And I'll take some time, carve out some time to take a look ahead at what the coming day or days will bring. I may, and given this is the my first webinar in a while at Epic Street, and given my focus is certainly a little bit beyond just the coming days, so I'll give you some clues as to at least my perception of things to focus on even in the coming weeks. And I'll try to keep some of my discussions briefer at times. I tend to ramble on about a lot of different things, go into a lot of great detail, and as a result, sometimes I'm left at the end of this 1 hour webinar with not enough time to cover some topics that I'd like to cover to help each and every one of you, at least in some small way, during this hour, perhaps, if not better your trading, at least give you a heads up for some things that could at least shake up the marks a little bit in the days to come. So again, the purpose of this event, each week I'll do this to look back at the previous several days of trading, setup that may have materialized, major news that could have affected the markets, and it's kind of a look back and look ahead. Look back, look ahead. Thursday's a good day I like for doing this because number one, it gives you a look at most of the trading week behind us before you have the weekend, before you kind of like forget what happened in the prior trading week. Also, a Friday, not always, but often enough, is a fairly heavy news day. And by my analysis, Friday is very often one of the bigger moving days. Well, due in part to news. So one of the bigger moving days amongst the major currency pairs. If you look at volatility by day, I haven't done this analysis in several weeks, but last time I did this analysis, looking at volatility on pairs like the Euro USD by day of week. Friday is one of the bigger moving days. Like last time I did the analysis, actually Thursday came out to be the bigger moving day. But of course, this Friday is notable because we got the U.S. NFP report due out, so that might attract a little bit of attention. So where do I start? Folks, I'll be honest with you, I could spend probably an entire hour, it seems, maybe it's speculation on my part, but I could probably spend an entire hour just talking about the ECB and the event. But I do want to, let's talk about a trade that came together during Tuesday's New York morning session, because that trade does reference a level that, believe it or not, had at least a very temporary effect on price action during today's New York morning session. And I'm going to go to a Euro chart, but by the way, you can see my view of several different charts, 15-minute charts all across the board here, Euro USD, pound dollar, Aussie USD on the top row. These are charts without indicators. I prefer charts with like indicators as a first look, just to get a sense of correlation between markets, not only between major currency pairs like the three pairs of the top row, but also correlation with other markets such as stocks. I got S&P futures there at the bottom. You get at least one peek at the commodities market with oil futures, and gold is sometimes spot gold can do its own thing, but even gold will sometimes show correlation with say the dollar. So this is one view I've come up with to look at a number of different things without getting too busy. I know many of you on your own charts and your own platforms with your own multi-screen setups, and I have my own as well. We'll have a lot more charts, a lot more data available to you, but this is one view I've come up with to look at multiple markets. I have some other views. Real quick, little tour here. I can look at some group of yen crosses, Aussie yen, CAD yen on the top row, Euro yen, pound yen on the bottom row. And I have separate profiles set up on this MT4 platform to look at multiple different currency pairs that with one single currency in common. A Canadian dollar view, a Australian dollar profile, which we'll look at a little bit because actually the Aussie USD is in last I checked is in an interesting zone. And I'll be talking about the Australian dollar. This whole session won't be just about the euro, but we'll start with the euro and one notable trade I thought that came together during Tuesday's New York morning session. So I'm going to go to view with the euro charts. I'm going to this view because it doesn't have much in the way of unnecessary lines on it. And I'm going to turn off both the chart shift and the auto scroll so I can scroll back on this chart. July 30th was Tuesday. And I want to get to, actually that's Friday. 27th was Friday. 30th was Monday. 31st was Tuesday. Sorry about that. Yeah, actually, you know what? I actually do want to go back to Friday because Friday set the stage for Tuesday's trade plan. So I'm sorry I'm scrolling around here. I'm on the 15-minute chart for the EUR/USD showing price action from Friday. And in my New York video view of Friday's New York morning session, I talked about a zone between 2275 and 2290. It's had a couple of lines there. There's a line at 2275 or close to it, a second line at 2290. And it probably would behoove me to go back in time a little further, and we'll look at price action. And actually, this shows exactly what I wanted to show. Last Thursday, and actually this sets the stage for today's move on the euro. As some of you may recall, or may be aware at least, last Thursday, ECB President Mario Draghi said some things at a conference for investors in London that really sparked a so-called risk-on mood in multiple financial markets and gave a notable boost to the euro. Look at this as a 15-minute chart, so that's quite a move on the euro. The euro was at levels, actually the day before, the euro had been to a level just like a mere 40 pips above the 1.20 psychological level. 1.20 was seen by many traders as a logical target for euro shorts that have been undertaken perhaps by some traders as long as months ago. So we got near 1.20 on Tuesday, and then I'm sorry, this was it was Tuesday. Then in the early part of Wednesday's London session, some of you may recall a member of the European Central Bank, namely Ewald Nowotny. They actually happens to be the head of the Austrian Central Bank. Nowotny was reported as having made comments about some pro-arguments for giving the ESM a banking license. The ESM is I'm not going into more detail than what some of you may want, but this is kind of how I roll, and I hope they can set the stage eventually for the trade on Tuesday, and then what happened, some explanation of what happened today. So as many of you know, Europe's had some problems, and leaders, central bankers, namely the ECB, and even economists are speculating, what can be done to fix Europe. Now, I'm not going to go into details about structural reforms and such. The question I'm going to discuss here is what can European leaders and central bank, the ECB, for example, what can they do to at least stem the crisis, to at least stabilize financial markets, to at least stabilize, the recent sell-off on the euro, to stabilize particularly the government bond markets. I'm sure some of you noticed how much the Spanish bond yields rose so sharply, particularly before up to through early last week. We saw on it was the day before Wednesday, it was last Tuesday, when the Spanish 10-year yield hit a new all-time high around 7.75%. For those who don't recall, for those who may not know, it was mere days, sometimes maybe a couple, 3 weeks after the 10-year government bond yield in Greece, Ireland, and Portugal. When those 10-year government bond yields rose above 7%, remained above 7% for several days, up to a couple weeks or so, those countries needed bailouts. Now, I don't know if there's anything that magical about 7%, but maybe it's mere coincidence. But it's certainly it's something that's been chatted about quite a bit in the market. And if belief can become reality, where if those holding or holders of, say, Spanish government bonds, and they see yields go above 7%, see the history of what happened with Greece, with Ireland, and Portugal before that, they're thinking, well, I don't know if I want to be sitting on my bond holdings, no matter how low the price is and how much I'll lose on them. So there was some concern about so-called contagion, and the spreading to not only affecting the Spanish government bond market and Spain's ability to service its government debt, but also perhaps even spreading to Italy as well. By the way, you can see me opening a folder here. I want to show you an image real quick that I posted on blog at fxbootcamp.com. Also the Forex Street, my Forex Street blog here. You cue that up real quick. The image I want to show you features this move as well as a couple of others. Here it is. Here we go. So this image shows an hourly chart, price action from essentially last Tuesday's lending close to the end of trading last Friday. And you see the annotations talking about the Spanish 10-year yield reaching a new all-time high, well above 7%. A new 2-year low on the Euro USD, not far above 1.20. The 1.20 area, again, seen by many traders as a logical target for Euro shorts. Then you get these comments by Nowotny, again, ECB Governing Council member Nowotny, a fairly notable figure on the ECB's Governing Council, who decides on monetary policy on behalf of that central bank. Nowotny made a comment about the ESM. So back to the ESM, the European Stability Mechanism. That is the permanent rescue fund for the Eurozone. Back in May of 2010, European leaders agreed to establish 2 financial funds for supporting European countries who are in dire financial distress. It was mostly targeted for the likes of Greece and maybe a couple of those smaller countries. It wasn't designed initially for a bigger country like Spain, perhaps out of optimism, perhaps out of ignorance. I don't know. Will history figure that out? But two rescue funds were formed for Europe then. The EFSF deemed a temporary rescue fund. The ESM deemed a permanent rescue fund, an ongoing rescue fund. The ESM was, as some of you may know, it was originally scheduled to go live early last month, about July 1st. Well, due to issues it'll take me too much time to walk through, the approval of the ESM, particularly of Germany, has been delayed. The German Parliament now scheduled to vote on the ESM, or to vote on Germany's support of the ESM on September 12th. And keep that date in mind, by the way, September 12th. September 12th. That could be a very important date for the currency markets, for the euro specifically, and for that matter, for the history of Europe. So keep that date in mind. So back to the Nowotny comments. So Nowotny mentioned the ESM. Why is that important? Well, the ESM, the rescue fund, currently has a capacity, if you will, of about 500 billion euros. That may sound like a lot, but by most estimates, that's not nearly enough to provide financial aid to the likes of Spain, or certainly not even Italy. Estimates vary as to how much the rescue fund needs, how big it needs to be. to support either a Spain or Italy or both. I've seen investments ranging from 1 trillion euros up to 1.5 or 2 trillion euros. By the way, a trillion euros is 1,000 billion euros. What a reason the Financial Times, maybe some other European papers don't like to use the word trillion. So, if those of you who are not familiar with the term trillion, I'll put it in terms of billions. 100 billion euros is seen as almost a minimum for how big this ESM needs to be to have the capacity to support the likes of, say, Spain if Spain needs a bailout. So the idea is, where's the ESM going to get the capacity? Where's the ESM going to get the capacity? Where's the extra firepower, if you will, going to come from? Well, the idea is, if you get the ESM a banking license, that the ESM could then borrow using some bonds as collateral, for example, could borrow from the European Central Bank. European Central Bank under treaty is prohibited from directly buying government bonds, directly supporting governments. So the ESM was seen as a way to, if given a banking license, would be a way to get around that. The ESM could borrow from the ECB and thus have more firepower to support bailouts if needed. So Nowotny, the ECB member Nowotny, last Tuesday, actually during last Wednesday's London session. Actually, the interview was recorded before that, but the interview was posted. It started last Wednesday's London session. Nowotny floating the idea of, maybe there's some pro-arguments for that. Maybe there's some pro-arguments supporting giving the ESM a banking license. Interesting enough, the next day what happens? Well, ECB President Draghi, speaking at a conference, addresses the issue, and interestingly enough, he addresses this issue 2 days after Spanish government bond yields hit a record high. The Spanish bond 10-year yield hit a record intraday high on Wednesday at about 7.75%. Next day, Draghi, speaking at a conference, at an investors conference in London, says is referencing what he called sovereign premia. In other words, high bond yields in the likes of Spain. He said something to the effect of, and I've actually got the quote here. Let me find the quote, the full quote. I've only got part of the quote shown here. The full quote, here it is. I'll post it in the room. Sorry about the voice. I've been talking for like 5 or 6 hours already today. I'm talking more, so my voice sounds a little scratchy. I apologize for that. Here's the quote. Oops, let me post it again. Here's the quote by the full quote, the full context of the quote by Mario Draghi. So what Draghi's talking about there, to paraphrase his comments, is that Draghi's was seemingly trying to build a case there for saying that, the ECB's mandate is to ensure that, its primary mandate is price stability. But his case the case he seemed to be trying to make was that if, to the degree that bond yields being too high keeps the ECB from doing its job, which is, the recent interest rate cuts, working its way through the financial system. If high bond yields prohibit that, then it's under the ECB's mandate, at least in Draghi's view at that time, it was under the ECB's mandate to take measures to enable that so-called monetary policy transmission channel, or to declog, if you will, that transmission channel. So this was interpreted as a signal by Draghi that the European Central Bank might restart its so-called bond buying program. I say so-called. The official name of the program, which has been dormant since March, is the Securities Markets Program, or SMP. It's the ECB stopped buying bonds, buying government bonds in the secondary market back sometime in March, and perhaps due in part to avoiding any situation where it was actually encouraging some sort of moral hazard. One concern of the ECB has been they don't want to be seen as supporting governments too much with the even sterilized bond buying, to the point where governments won't have incentives to do reforms, to pursue austerity measures, and reduce their budgets and such like that. So anyway, Draghi, bottom line, on Thursday, gives the market what the market perceived to be a very strong hint that the ECB was going to get back into the world of bond buying, either through the Securities Market Program perhaps through eventually a step towards granting the ESM a banking license, and where it could borrow from the European Central Bank, blah blah blah. So the market's thrilled with that. Euro jumps, and several markets jump. Risk on virtually everywhere. Sharp drop late last week following those comments by Draghi. Sharp drop in Spanish bond yields. Spanish bond yields got down to like, was it yesterday or today, around 6.6%. Big, actually it was just earlier today, 6.6% on the Spanish 10-year. And then we get some other commentary from other, Merkel and Holland, for example. German Chancellor Merkel, French President Hollande both make some arbitrary supportive comments of the euro. Same kind of stuff they've made in the past, but it just shows how sensitive the market has been to the prospect of, at least someone in Europe, it looks like the ECB, perhaps getting ready to make a major move, a policy move to, which would be a euro positive. So that was some of the drivers behind last week's price action. So the point I wanted to get to with this range between 22.75 and 22.90, if you look at price action, my line's at 22.90, but on my video review from last Friday, I had it close to like 87. You can see out on the upper right-hand side of this chart. Let me get my drawing tool going here. We had some highs here, lows there. This is during the Friday's New York morning session. I'm sorry, Thursday's the New York morning session. And Thursday. Friday we get a bounce in the 2250 zone, which has been important in the past. And you get a second chance if you missed that early London session long on Friday of the Euro USD. Remember that 2275 level, which seemed to support the euro during the New York afternoon on Thursday? Well, it came into play again on Friday. So that was a logical long trade on Friday on the back of perhaps the expectation of more of a show called short squeeze. The idea was that at least some traders who had shorted the euro in the past were looking to cover the shorts, looking to buy back the euro. And so the idea was that I think that move got a little help from comments from some officials. I think it might have been Holland again, who made some comments to give the euro a bit of a jump during Friday's New York morning session. Anyway, another example of how the euro seemed to respect that 2275 zone. So that fast forward to Tuesday, and here's Tuesday. Let me go to right there. Actually, I probably should make these lines to a couple different colors, but I'm going to leave it for now and highlight with my marker again. This is 2275. Again, this is a 15-minute chart. Folks, this happens not all the time, but quite a bit. One level or one zone, sometimes a 10, sometimes like a 15-pip zone, can have a persistent effect on price action. Maybe even if only as like a speed bump. Sometimes you get a situation like this. Actually, and I'll show this a little bit. Situation where in a downward move, price just responds briefly, stalls there, and that a zone has been important in the past, and then continues down. I'm going to show that a little bit on the 1-minute chart for the euro. So there's a quick summary of, and maybe it's been too quick. If you have any questions about that, let me know. Magnet's posted a comment there. That's a quick summary, particularly on the euro, of some news flows, some commentary out of Europe, plus some price action. Again, the main theme in terms of not only price action, but in terms of the market's perception and mood was that there's been some building expectation about Draghi and the ECB doing something notable at today's meeting. And yeah, there was some notable moves, some decent setups on some other currency pairs and other individual currencies per se. But the real theme, and it's been a very pretty consistent recurrent theme, is markets by and large have been driven by Europe. Europe's been driving the bus, so to speak. Yeah, we had the FOMC meeting today. I want to talk about that here in a moment. Actually, maybe I should talk about that now, since that this long on Tuesday around 2275. Perhaps you take profit at 23.30. The 23.30 area has been important in the past. The 23.30 level is very close to the 2008 low for this pair. And if you look at a euro chart, which I'm not going to do now, but maybe perhaps I can do it later. You could do it on your own. If you look at a euro 4-hour chart or perhaps a daily chart, several highs in the euro been established in the 15 to 23.30 area over the course of the last month. So anyway, that was a logical long around 22.75. Take profit at 23.30. I believe there was a weekly or monthly pivot point, perhaps a weekly M4 near there as well. I talked about it in my New York session video review for last Tuesday. So that brings us to Wednesday. Actually brings us to yesterday, I should say. Notice the sharp move down on Wednesday, and notice also that this pair topped out. Let's support that in a separate line here at a line at 23.30. And now that I think about it, it was a monthly central pivot point that's in the 23.35 vicinity. A monthly central pivot point, believe it or not. But even though this is a new month, now we're in August, so if we were formerly in July, this 23.30 area has been it's had a history. It's shown a history of moving the euro. I'm going to put a red line there at 23.30. There we go. And by the way, that short, the 23.30 came together not long after the open of yesterday's London session. So for those who shorted the euro at or near 23.30 and held on to it and held on to it through the FOMC announcement during yesterday's New York afternoon session, you got paid. You got paid. Yeah, Magnet, I'm going to get to that. This is a look back, and I'm going to get to look forward and things to look for moving forward. And by the way, Magnet, I'm not going to give you because it would just take too much time. I'm not going to give you all the secrets straight. I will give you before the end of the session some nuggets of information to something useful. Actually, Magnet, I've already given you one useful nugget of information. And let me repeat it. It's this zone. And the currents of such zones on not just this pair, but even several other pairs. So, sometimes, some days, some weeks, perhaps over a longer period of time, certain zones can have a persistent effect on price action. Over the past several days, it's been the 22.75 to 22.90 zone. But and also consider that my review of some of the things that have moved price action, moved on for the euro USD, for example, over the recent days. I mean what I'm building up is the case for what's been moving the market lately, and I'm going to use that information to point to some events coming up in the coming days and weeks that you can use potentially to make money from the trade. So I hope that helps. This drop on the euro, initially a knee-jerk reaction, it seems to me, to the perception, and rightfully so because the Fed really didn't do anything, the perception that the Fed the market thought the Fed was going to do something, but it didn't. Simply put, there was some hopes, and I get this because if you watch enough economists and analysts and read enough and see enough interviews with economists, analysts, and hedge fund managers and such, there is a wide variation and speculation about what the Fed would do at yesterday's FOMC meeting and announcing their FOMC statement yesterday. Now, that kind of variation, wide variation in what people think right or wrong the Fed will do can mean could set the stage for a notable move as those who are wrong get out of any trades, or maybe those who are right, potentially add to the trades. But this drop down in the euro, at least the market's initial reaction to the perception that the Fed just did nothing, which the Fed effectively announced nothing new in terms of a new policy move, like more quantitative easing at yesterday's yesterday's FOMC statement. Now, I'm trying to think where to go from here because I want to touch on FOMC or the quantitative easing a bit, and I probably need to scale back my presentation because I'm afraid I'm going to get into too much technical detail when some of you may not know, have little background, a little knowledge or understanding of classic quantitative easing. So let me put it this way. When the Fed or market anticipation that the Federal Reserve or other central banks let's just use the Fed as an example. To the degree that the market expects the Federal Reserve to do more quantitative easing, like to print more money to buy, say, Treasury securities, which are U.S. government bonds, or to, say, buy mortgage-backed securities, which some speculate the Fed could do that. The market prefers to sell the dollar in anticipation of that. Now, the reasons for that, well, let's just put it this way. I could talk about some reasons why the market would even do that, why the dollar would fall under pressure. You could really boil it down to supply and demand. What the Fed is, what central banks do when they do so-called quantitative easing is sort of create money. So if when the Fed, for example, creates more dollars, puts more dollars into the financial system, you have greater supply. When there's greater supply of dollars, the value goes down against other major currencies. Now, maybe that's a very quick and even quickly spoken on my part explanation, but that's one way to look at it. It's basic supply and demand. You have any item, if you increase supply, price goes down. If demand goes up, price goes up. So anyway, there's so the prospect of more quantitative easing by the Fed, when the market believes that the odds or probability is higher of more quantitative easing by the Fed, the dollar sees pressure. When the market perceives right or wrong that the odds of more QE by the Fed are down or less, the dollar gains strength. Now, there's a clue here. And maybe this is a clue, one clue that you can use in your trading on the Euro USD. There was what could be a clue, what could prove over time to be a clue from yesterday's FOMC statement. And I'm actually going to the statement itself on my other PC. I've gone to federalreserve.gov. I'm clicking on one of the first links on their home page, which is a link to their press release yesterday. One thing the Fed said yesterday, I can even type in the comment. The Fed used a phrase in their FOMC statement yesterday they haven't used in quite some time. Actually, haven't used at all since Federal Reserve Chairman Ben Bernanke became, the chairman of that central bank several years ago. Back in the day before Bernanke, when Alan Greenspan was chairman of the Fed, what they did at times was use language like this, and I'm referring to the Fed's FOMC statement released yesterday. Committee, you can see me typing this. Actually, let me do this first. FOMC, the committee. Forget my typing errors here. The committee will closely monitor incoming information. And it goes on, blah, blah, blah. And provide additional accommodation as needed. Now, what's the big deal? Actually, monitoring closely, that's a kind of phrase that the ECB has used in the past. When Trichet was at the helm there, and I believe at least once the ECB and the regulators done the same thing. Well, the Fed hasn't used that language in quite some time. In the past, when Greenspan was in control at the Fed, when the Fed used that kind of language to closely monitor, not always, but there's been times when the Fed has done what's called intra-meeting move, an intra-meeting easing. In other words, when's the next Fed meeting? I believe it's sometime in September. I don't have the exact date. Apologies for that. But in the past, at times, after a reference to closely monitoring income information, if things have gotten, say, worse, the Fed has acted and made a move before their next meeting. So there's a possibility. In other words, if the Fed, there's perhaps some perceptions in the market the Fed has left the door open to make a policy move, if not at their next meeting in September, perhaps even before it. So, and I don't know how much that's been discussed. I've seen saw one reference to it amongst the different media and economists and analysts that I monitor via my Twitter account. That someone made reference to that. I've looked into it at least a little bit with what time I had since the FOMC statement came out. Yeah, there seems to be some truth to that. So that's something you can use perhaps, in the coming weeks. That there's perhaps misguided speculation about, in terms of yesterday's reaction, misguided speculation about the FOMC not ready to do anything. Perhaps the FOMC is poised to do something if things do get worse, either in the U.S. economy or perhaps even in Europe. So in my mind, there's still a possibility of more QE, which means dollar weakness, which means up on the Euro-USD currency pair, the charts for which you see now. So if you think this drop in the euro we see on the 15-minute chart is the correct reaction, maybe not. History may show over the next several weeks the Fed, made a move, so the possibility of QE is still on the table. Perhaps the market eventually will start figuring that out, and we'll see the dollar weaken more than strength. Okay, so that, for what it's worth, I hope that helps. If I need to explain that further, I'd be happy to, and maybe in a different way. But that is one of the notable takeaways and one of the notable clues from yesterday's FOMC. Perhaps the market perceiving that QE is not on the table, which would be a dollar negative. But my perception is it still is on the table. That takes us to today. Boy, look at that move. I got to go to a 1-minute chart today. Correct. Go to auto scroll here first to get the chart to present price action. Now let me go to a 1-minute chart and turn off auto scroll because I really think it's worth a look at 1-minute price action. You really have to look at the scale on the right-hand side of the chart to get an appreciation for what happened today. You can see on the left-hand side of the chart, let me use the drawing tool here. Actually, Gavin, thanks for comments, and Solman as well. Let me catch up on comments here. Yeah, Solman, actually your timing is good, Solman, because I'm about to get to that. Views on the euro. Yeah, Cam, I see your comments, and yeah, that makes some sense. So what happened here? Well, how many of you recall? Maybe no one does, and that's okay. But it was I recall this distinctly because I was conducting a live coaching session at the time, watching the charts like a hawk, the euro charts were like a hawk. Last month, I believe it was July 6th. I may have the exact date wrong, but at last month's ECB rate decision. Was watching the euro. We were waiting for the news came out on the ECB's rate decision. The ECB in their benchmark rate, which used to be at 1%, they cut that 25 basis points. So the rate cut, the cut of the ECB's benchmark rate, or 25 basis points, was announced. No perceivable reaction on the euro. The euro hardly budged, and frankly, that's pretty typical. Typical for the euro to do very little to nothing in response to an ECB rate decision, whether it's a move or not. Part of the reason for that may be just the ECB has traditionally been pretty good at telegraphing its rate cuts or hikes, whatever the case, before they actually do it. Now, did anyone notice? I'm not going to go back to the euro charts, but you can look at the euro charts for that day, and I believe it was I think it's July 5th. Wednesday was July 4th. If you look at the July 5th charts for the euro, you should see a reasonably sharp drop that day, particularly starting after 7:45 a.m. New York time that day. Well, the euro started dropping and virtually never stopped. That day on July 5th, following an announcement by the ECB that it would cut its deposit rate. That is considered by some, the ECB deposit rate, considered by some to be the more relevant rate. And the fact that the euro dropped in response to the cut by the ECB of its deposit rate, that drop is one that the kind of move that has been traditional in terms of response of the euro to an ECB rate cut. And the driving factor there is simply interest rate differentials, bond yield differentials. If when you see say the ECB's rates getting lower relative to rates set by other central banks, the euro can weaken. Now that kind of move has been mixed in the past several months because some of the things the ECB have done have not been a rate cut per se, but have been other measures such as LTROs. These are some of these unconventional policy moves. 3-year loans to Eurozone banks totaling 1 trillion euros. That's actually, if anything, been a brief, a near to medium term euro positive. So we've had some mixed reactions on the euro to ECB policy moves over the past several months, especially since Draghi took the helmet at central bank. But the drop last month on July 5th, more of a classic move in terms of how the euro typically reacts to rate cuts. But look where we're at right now. Now we're in a phase where the ECB has cut its deposit rate to 0. That's the rate at which they pay interest on deposits held by Eurozone banks at the ECB. So there's the Eurozone banks get no return on their money if they park their funds at the ECB. And now, so the benchmark rate is now 0.75%. So the point I'm trying to make in my typical roundabout way is that the reactions on the euro have varied depending on what the ECB does. ECB rate cut, especially the deposit rate cut last month, ECB the euro dropped. Other moves made by the ECB have been perceived, right or wrong, by the market as a euro positive. So there's two kinds of moves the euro can make, and we saw this last week in response to the comments by the likes of Nowotny and Draghi. When the ECB does something that's considered a broad eurozone or supporting the eurozone positive, and other than say a classic rate cut, it's the euro has jumped. When the ECB has made its rate cut, the euro has dropped. It can be tough to figure out, I admit, but as I see it, that the thing the ECB will do if they do so, and it's been pretty consistent, is to the degree that the ECB eventually, maybe they will eventually get involved in buying bonds again. That could initially be a euro positive. I say initially, meaning it could be at least for a day, for a week, perhaps longer. The longer if the ECB, even when the ECB does eventually get involved in bond buying, perhaps reactivate their securities markets program, to the degree the ECB accumulates more and more government bonds and bulks up its balance sheet, that could eventually turn into a euro negative. But in the near term, it would be, I'm guessing it's going to be perceived as a euro positive, especially given the recent price action we saw last week on the hopes that the ECB would, in fact, do some bond buying. So my point is this with regards to today's price action on this 1-minute chart. We saw the euro rise from here to here on the back of no rate cut. Again, a classic move here on the euro up in response to no more rate cut. That's happened several times in the past, several years. When there's at least some expectation of a rate cut by a central bank, the central bank doesn't cut rates. It's a positive for this corresponding currency. So we got a little boost on the euro in response to that. Perhaps part of the reason for the boost in the euro was speculation, building hopes that Draghi would follow up on his promise from last week, or at least his implied promise, his seeming commitment that the ECB would do something like start a bond buying program, or perhaps show their endorsement for a banking license for the ESM. Well, notice what happened up here. We saw the euro jump briefly as during the introductory statement by Draghi at the press conference at the ECB headquarters in Frankfurt. If you look at Draghi's early comments, and I'm going to the ECB webpage to reference that, he does repeat some of the themes that he mentioned in the speech last week in London. He talks about the so-called premia that have accumulated on like Spanish government bonds. I'm looking at the ECB's introductory statement right now. I mentioned the weak economic growth, ongoing tensions in the financial markets. Essentially reiterated some of the concerns that he's mentioned in the past. And it seems like the way Draghi positioned that in his introductory statement, the market perceived that Draghi setting up here. You see the euro rise in this area here. The euro was just ramping up in the first few minutes of his introductory statement on what seemed to be building hope that Draghi would deliver that punchline. Say, we're starting the S&P program again, the bond buying program, or something else, anything else. And as it turns out, I would say there's one key word in it looks like the fifth paragraph. Actually, the word occurred more than once, but one particular word that I think that really spooked the market. May. M-A-Y. May. And I'm reading from the fifth paragraph in the introductory statement. By the way, I could give the link to this. But if you go to the website, go look on the ECB's website, ecb.int. Go under press conferences, and you can look at the English version of the transcript for Draghi's introductory statement. And I'm looking at the fifth paragraph, and I'll read a little bit. The governing council, within its mandate to maintain price stability over the medium term, and blah blah blah. The governing council, that's essentially the ECB, may undertake outright open market operations of a size adequate to reach its objective for price stability. Furthermore, the governing council may, there's that word again, may consider undertaking further non-standard monetary policy measures according to what is required to repair the monetary policy transmission. So essentially, Draghi in the speech last week builds the case, is talking about, in order to facilitate what they call proper monetary policy transmission. In other words, they made a rate cut, but the ECB, Draghi in particular seems concerned about the rate cuts not feeding through the financial system. So in order to make that more effective, Draghi is trying to build a case, and referenced that in his speech last week, trying to build a case for buying government bonds in the likes of Spain to bring down bond yields to enable that so-called monetary policy transmission. If it sounds a little confusing, it can be even for the best of us. But the point is that Draghi is trying to build this case for buying bonds, which, right or wrong, the market was perceived as a euro positive. But although Draghi has built a case for it, he wasn't able to follow through on it for whatever reason. So the market expected that the ECB and through Draghi's statement would announce something new, some sort of bond buying program, some sort of intervention in Eurozone government bond markets, and he didn't do it. He said they may do this. They may pursue some sort of either bond buying or some sort of other non-standard new policy measures. And once the market got whiff of the May and the fact that there was no announcement, boom, the euro just absolutely tanked. And this kind of goes beyond sort of a buy the rumor, sell the news, which maybe you may have heard of in other financial markets. This was this was merely some disappointment. This is disappointment that the ECB was expected to do something right or wrong, and they didn't deliver. Oh, and back to the point I made earlier when Magna brought up the point of how can you use the information in trade. Well, notice the euro sell-off here. Let me reactivate the drawing tool. So from a top around 1.24, once the market realized, oops, the ECB is not doing anything today. Down, 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 down. This is a 1-minute chart. Brief hesitation at that 1.2330 level, which had been important before, not just today, but over the past several days and weeks. And what was the next hesitation? That 2275 to 2290 zone. I mean, the most notable hiccup in the euro's sharp drop down from about 1.24 down to about 1.2170. One of the most notable hesitations in that same 2275 area. So what could you do with that? Let's get back to the charts here. Well, this is a 1-minute chart. Let's go to a 5-minute chart. Well, I don't know when, I don't know how, but at some point, maybe today or maybe tomorrow, maybe early next week, if the euro gets back to that 2275 area, and you have reasons to believe, which are probably too numerous to maybe get into some of the reasons perhaps next week why that would be the case, but I can imagine a few euro bears, or perhaps dollar bulls is a better way to put it. I can imagine a few euro bears looking to short the euro at or near that 15th zone between 2275 and about 2290. I mean, it's if there's one thing I want you to walk away with is that certain areas have a fairly repeated effect on price action, a regular influence on price action on multiple occasions. I mean, not always, but often that's the case. Look at today's lows, for example. Now, part of the reason behind the U.S. bottoming out for today could be the end of the European trading day. Traders have already made their money, and traders start leaving the charts, so the euro just sort of stalls out. But I find it interesting that the euro did so around 1.2150. What's so important about that? Well, let's look at a 4-hour chart. This is a 4-hour chart for the euro. And by the way, I'm going to segue from this to I haven't even touched on the Aussie. I was saying earlier that I was hoping I'd have time to touch on that. I'll at least make a couple brief comments about the Aussie, and then I want to give you some things to think about in terms of or the things to look at in terms of future news events. So back on this Euro USD 4-hour chart, look at this range from about 2150 to 2165, represented by two horizontal blue lines. The thicker blue line is at 2150. Now, maybe it's just me, but that roughly 15 pip zone seems to have affected the euro in the past. Now, what's so important about 2150? Well, 2150, if you look at a daily chart for the Euro USD, and I won't go to this chart because I'm in the interest of time, but look at a daily chart for the euro from about mid-May or start of May in 2010 to the end of June in 2010. That 1.2150 area seemed to define several bottoms on the euro during that span of time, around mid-2010. And sure enough, it's been important recently. Boy, I want to talk about the Aussie real quick. Anyone notice that the Aussie? Let's go to the Aussie charts. Has anyone noticed the Australian dollar's recent strength? Surely someone has, or if I just lulled everyone to sleep. Interesting area, by the way, for the Aussie. I said that earlier, and I'll say it again. This is a 4-hour chart for the Aussie USD. See some high established around July 19th there. Some upper wicks on a 4-hour chart for the Aussie established in late July there. A low there. Was it yesterday's low there? And we're back there again. That 1.0450 area seems to have had some influence on the Aussie. Yeah, Gam, I don't show it here, but I have separate charts showing what is a nice upward channel. The top of the channel somewhere in there. And you can see a couple of lows that form the base of the bottom of the channel. Absolutely. But the thing I wanted to emphasize was, why up? Why I've heard some commentary from some other traders, even at Coach at FX Bootcamp, talking about shorting this pair. Now, shorting this pair may very well work at some point. At some point. But in my mind, it's worth noting that even as of yesterday, just barely yesterday, we got a new multi-month high for this pair. The Aussie USD reached yesterday its highest point since, I believe, March 27th. Multi-month high for this pair. The rise in the Aussie against the dollar since about the 1st of June has been much more notable than the euro recovery, even than the recovery of the British pound against the dollar. Now, why is that? Well, there's several reasons. I may even have available to me an annotated chart showing the some reasons why the Aussie has been some recent news flow is suggesting I don't know if I could find that chart. I don't know if I have that chart available to me. But what strikes me is this. For the moment, at least, the Australian Central Bank has paused. It cut rates a couple of times back in the spring. The Australian Central Bank paused right now. That's number one. Number two, although the data in China has been relatively weak, China is important because China is a major trade partner for Australia. Australia is a resource commodities-rich country, and a lot of those commodities are gobbled up. Not a lot, but quite a few are gobbled up by China. So one could argue it's pretty a broad brushstroke conclusion, but as China goes to some extent, so goes Australia. So there's been some concern though for a while, for several months at least, about is China in for a soft landing or a hard landing? Soft landing or hard landing? Is China going from like 9 or 10% growth down to say 3% of low growth, or is China just merely normalizing to something closer to like 7 or 8% growth? If China can retain its like 7 or 8% growth, things are at least okay with China, with Australia, that is. If China slows down more significantly, then that could weigh the Australian dollar. Well, recent data from China has been, for example, the PMI reports, the Purchasing Manager Index surveys, for example, the China manufacturing sector. The headline numbers have been below 50. We've seen some at least modest contraction in the China manufacturing sector, but it hasn't gotten worse yet. It hasn't gotten worse. In fact, I recall the response to a recent China PMI number. It might have been the number released during last Tuesday's Asian session, but it could have been the number of China's report. I think it was maybe it was China GDP, a China GDP report from late last month, where I'm sure it was China GDP, where the GDP number came in about as expected, and the Aussie rose. Perhaps on the back of concerns that the China could be slowing more sharply than what it actually turned out to be. And so my point is this: I can name a number of different possible reasons, but whatever the case, the Australian dollar has shown notable strength in recent weeks. Notable strength, and perhaps one reason for that, and I know I'm getting close on time here. Black Cat, I agree. In terms of buying the dips on the Aussie, I totally agree. Until buying the dip stops working, until we see, for example, the Australian dollar stop reacting positively to anything that would be a logical Australian dollar positive, like say stabilizing data out of China, or like, for example, better than expected retail sales data out of Australia, which we saw yesterday. Let me show you one of the main reasons you can justify until this changes, or until something else affects it. Certainly, like, for example, maybe China is going to slow more sharply than previously thought. Where is this? I'm looking for my. Here we go. Here it is, folks. Bond spreads, interest rate differentials, yield differentials. Call it what you want. Looking at it, this was as of July 20th, I think it was. So this graphic is a little bit dated, a little more of a week dated. But compare, for example, the yield on a 2-year Australian government bond, around 2.5%. Compare that to a U.S. 2-year yield. The U.S. 2-year yield, I haven't seen that today, but U.S. yields, as are the yields of many other 2-year government bonds, close to zero. That favors, if anything, the Australian dollar. Money tends to flow to where it's best treated. If money, investor money, central bank funds, whatever, if money is looking for a higher yield, or looking for some sort of return, some equity markets are seen as risky, and now more and more than ever, some government bond markets are seen as risky. Of course, the periphery of Europe, Spain, Italy, and such are seen as riskier markets, no longer AAA rated paper. Yep, if you go to like to Germany or the U.S. to park your money in government bonds there, I mean, U.S. bonds yielding next to nothing. So-called zero interest rate policy has brought, and of course some concern about Europe as well, have brought down so many government bond yields. So where do investors go to park their money and at least earn some return on some yield? Well, one potential place, and it's still AAA rated, is Australia. So that to me, that is one notable factor behind, maybe not the only one, perhaps not even the biggest one, but one notable factor behind the Australian dollar's recent strength. And, until things change, until we start seeing, especially patterns on the price charts where we get lower highs and lower lows, and break out of this channel that Gam referred to earlier. Draw real quick the channel for you. It's you can go with this and something like that. There's a channel. And until we break out of the channel, until we start seeing more negative reactions to either news out of China or whatever else. This is a pair, as I see it, worth buying on dips. Worth buying on dips. I just realized it's 2 p.m. New York time. A couple really quick things, and promise Epic Street I will not dally long on this. A couple of things I would watch for in the coming weeks. September could be, as I said earlier, could be a very big month, very good big month. But before that, I'm anticipating that we're going to see a lot of very technical trading, maybe even some somewhat limited volatility, similar to what we had at times last month. I mean, this is kind of the heart of the summer trading season, the heart of, we're about to enter the summer vacation season for Europe, so sometimes volatility in the currency market it gets a little lighter, it gets a little less price movement on August as traders and even some hedge fund managers are away on vacation in August. So that could limit some price action this month. But you know what? That makes this a very good month, in my opinion. A very good month to work on your game, to hone your skills, especially your technical trading skills. But things to focus on. I believe that it's going to be worth looking at the Fed's, the FOMC next meeting minutes. The next FOMC meeting minutes. In other words, what was discussed at yesterday's and Tuesday's FOMC meeting. I want to see how likely or not more quantitative easing. How poised might that central bank be to do more QE? And I don't have. Let me do a quick scan of the. I'm not done with August, Black Cat, but I'm saying September could be a even bigger month. But let's start with August for now. I believe the week beginning Monday the 13th. It's going to be the release of the minutes. Oh, I'm wrong about that. I don't see them right now. It's coming up soon. I don't have a date on that. Well, one day to watch. Maybe it's next week. Yeah, I normally have these dates right at grass. So maybe it's going to be week of Bernanke's his Jackson Hole speech, which is the next thing I wanted to point out. Here we go. I got it right. Okay, that is an interesting week. The week from August 20th to August 24th. August 21st, after London close, the release of the FOMC meeting minutes. That could reveal some clues about whether or not, and of course I'll have some webinars here between now and then, so we'll talk about that further. That will reveal some clues, could reveal some clues as to whether or not the Fed is edging closer to more quantitative easing. If Bernanke chooses, Federal Chairman Ben Bernanke chooses, he could announce some strong hints about more quantitative easing at his scheduled speech in Jackson Hole, Wyoming, at a conference of central bankers hosted by the Kansas City Fed. That's going to be on Friday, August 24th. He's done so before. He could do it again. Drop some pretty explicit hints about a policy move at that meeting. So I wouldn't be surprised, especially if the U.S. economic data gets weaker, especially if we get a poor NFP report tomorrow. If we see some gradual dollar weakness at times, as the market speculates, before any comments by Bernanke, or even before the release of those FOMC meeting minutes on Tuesday, August 21st, speculation about more QE. Beyond that, I would keep watching the commentary out of Europe. I mean, like it or not, whether I like it or not, whether you like it or not, further commentary by the likes of Draghi, by other officials at the ECB, perhaps by the likes of the German finance minister, or even the head of the Bundesbank, Wiedmann. I mean, these things can still affect the euro. So the market's going to continue speculating as to whether or not the ECB will make a policy move, or perhaps some sort of other move by major European leaders. But in terms of anything significant happening, it may not be until September in terms of the Europeans doing anything. September 12th, again, is the vote by the German Bundestag on the ESM, the Permanent Rescue Fund. Also, September 12th, a vote in the Netherlands. That's interesting because that vote could be a sort of an indication of the viability or not of things like austerity measures and things like countries like the Netherlands supporting the countries needing bailout, like Spain or like Italy. And I think I'm about done there. I mean, I hope you realize I could go on. But I'm well past my time, and I want to be respectful of everyone's time here, especially the fine folks at Epic Street who took the time and have taken the effort late in their day to host this event. Keep me in line. So thank you again very much to Epic Street. If there's any comments I missed, any questions I missed, I apologize for that. If I'm not saying Epic Street has to, but if they choose to remain the room open, feel free to post a comment or question again. I can address it in a typed message, or I'll be back here same time, same place next week. We can talk about things then. But keep an eye, obviously, on NFP tomorrow. That should be could certainly be a market mover again. Do I know what NFP is going to bring? No, I don't. I really don't. We've seen some mixed signs in U.S. economic data of late. Certainly, the recent NFP reports have not gotten any better. Things have gotten a little bit worse. So markets could brace for another weak number, perhaps from NFP. If we get another weak number, it's a very good possibility that the euro USD rises on the back of, again, renewed market speculation of more QE by the Fed. Jack, I didn't talk about dollar yen. Dollar yen is, as I see it, going to be largely a function of what the Fed does, more QE or not. There's been some chatter by and the chatter has been pretty persistent by the Japan's Ministry of Finance and the Central Bank of Japan. The Bank of Japan, they keep talking about watching the currency market, watching the yen, watching the currency market. And I think the market's just tuned them out. The market's just like, either put up or shut up when it comes to any prospective intervention. I mean, they just haven't come through. They haven't. I'm not saying they should, but the health of the Japanese economy, any prospective policy moves by the Bank of Japan or Ministry of Finance just have not affected the yen much. There's been some times this year when the yen has moved uniquely, perhaps on the back of speculation of or actual announcements by. For example, the Bank of Japan did announce something close to an inflation goal or inflation target at their February 14th meeting, but that seemed to spark some unique price action in the Japanese yen, and even saw some price action leading up to the late April Bank of Japan policy meeting. But since then, the Japanese yen has largely been a function of risk on, risk off, of global risk appetite. Stocks up, yen weak; stocks down, weak, yen strong. So that leaves perhaps the dollar, and the dollar as I see it is sometimes it responds to events in Europe, but the dollar could certainly over time respond more to the prospect or not more quantitative easing. If the Fed does more QE, if the Fed does that, it's going to mean down for dollar yen to some degree. Now, and of course, that's going to be a thing that makes things more complicated for the Bank of Japan, because if the dollar yen gets low, it's going to bring about concerns about the strength of the yen against the dollar, and perhaps even more talk about intervention and such. But we'll cross that bridge when we get there. I don't trade the dollar yen that much because the days like this, for example, on days like this, both the dollar and the yen were strong. Dollar yen in that situation does virtually nothing. Folks, have a great day. Sorry if I didn't get to all your questions and comments. This is pretty standard stuff in terms of how I talk through things. I know I threw a lot of information at some of you, and I apologize. I didn't mean to be confusing. Wasn't actually looking to impress. It just I'm really interested in this stuff. I really enjoy talking about this stuff, and sometimes I can ramble on and seem like endlessly about certain topics and maybe go into too much detail. But I hope for some of you it helps. And if you feel like still feel overwhelmed, believe me, I was in your shoes just 4 or 5 years ago. Actually, a little longer than that. But I mean, I still remember the time when I saw all this is just so much to take in, so confusing. Believe me, it is. Believe me, it is. But you got to give yourself time, maybe not to grasp it all. I mean, there's still things I'm learning every day, but at least you want to get yourself to the point where you recognize when certain events, when certain things can be important, and adjust your risk accordingly and adjust your decisions to trade or not accordingly. Have a great day, folks. I'll see you soon. This time, actually, just almost a week from now, we'll do this again at 1 p.m. next Thursday. And thanks again to Epic Street for inviting me back and for hosting this session. Really appreciate it.